and the mic is yours.
Okay, well, thank you, Mike, and we're happy to be here. And Deline will be here keeping me on track and making me behave myself. Again, we are very excited always to participate with the startup community. And we hope everybody will take something from this that will benefit them in the future. We're doing tax tips, but always with tax tips, you have to start off with the type of entity you have, because that kind of goes hand in hand. And that's where, we get a lot of missteps or where a lot of issues arise. So we will start with, there's my information, but we will start with choosing the type of entity and go from there, and the different tax implications on the different types of entities, and then get into some other tax issues. So again, just introduction, choosing type of entity to use to form and organize a new business can be challenging. You have to weigh the cost and benefits today versus the cost and benefits in the future, when we really don't know what the future will bring. That was really a question a couple, I guess, less than a month ago. So anyway, a lot of times the business concerns, especially when you're talking about getting investors and stuff, those might dictate one thing, while the tax sense might dictate something else. And of course, you also have the flow through credit, or the QBI, or many other names it goes by, that comes into play for certain flow through entities. So we're going to start off, going over the different types of entities. Then we're going to talk about some entity classification and filing requirements, and then get into employment taxes and employment benefits for the different types of entities. And that's really how it relates to the owners. And then we'll do a little comparison on different types of entities and the resulting results there, and some income tax and other considerations. Okay, these are really your basic type of entities for an operating business. Now, we really won't address the top three there. Those aren't that popular anymore. Sometimes the sole proprietorship might be a starting point just before somebody has a time to actually set up the entity. But for the most part, people want the limited liability that comes along with a type of entity, such as a limited liability company, LLC, a regular corporation, or a subchapter S corporation. So just some background on the limited liability company. This is kind of a hybrid business that provides the owners limited liability advantages like a corporation has, but you also get pass-through tax treatment. So it's, and then also when you develop your operating agreement, you can make it pretty flexible on how things are run and how different allocations are made. The owners of an LLC are called members, as opposed to shareholders in a corporation. You can have a single member, you can have multiple members. The types of owners that you have, they aren't as limited as what you get with other flow-throughs. And then also all owners have limited liability. One key there is that you're setting this up as a legal entity, as a company. You have to run it like a company. It needs to keep its own books and records and so forth. And that's what protects your limited liabilities, so you can get that benefit down the road if it's needed. There's flexibility in a limited liability to determine which members are involved in the business, who manages it, how the governance works. And you can also, as I mentioned before, use the LLC to create limited liability for a single person, a sole proprietorship. But you do have to watch out, because there could be some state taxes at the LLC level. As I mentioned, the LLC in its purest form is basically, it's a pass-through entity. So it kind of works like a partnership does, or a sole proprietorship if there's only one person, where ultimately the owners pay the tax on their share of the profits when they file their 1040s. Again, I think I mentioned these advantages: limited liability for the members, flexibility in the economic and governance, and pass-through taxation. There is some check the box rules. We won't be discussing those today, but you know, if you have a LLC as a partnership, you can check the box and basically turn it into a corporation for tax purposes, but I don't think we need to get into those today. Some disadvantages, you know, there are some state filings where filing fees may be collected. Kentucky, of course, they do have their LLET that everybody has to pay $175 on for every LLC. They are, LLC, limited liability is dependent on observing and maintaining the corporate formalities. As I mentioned, you know, own books and records, have your meetings, have your minutes of your meetings and that sort of stuff. Keep that in check. Try to keep your personal funds, you know, away from your LLC funds, and just, you know, keep that segregation in place. The LLC agreement, which we call an operating agreement, that can be as simple or as complex as you want, you know, just depending on what the situation, you know, requires. And then, as I mentioned, you know, you might be subject to state or local entity tax. You know, if you are a limited liability company here in Louisville, the company will pay tax at the company level to the Louisville Metro, and as it does the LLET to Kentucky. Corporation, you know, this is what comes to mind to a lot of people. It's a lot easier to comprehend a lot just because they're so used to hearing about, you know, owners and shareholders and so forth, and articles of incorporation and bylaws, you know, the basic documents. Those have been around so long, people are used to hearing that. The owners are the shareholders or stockholders. They purchase the stock with money and other assets of the and the corporation uses that money to go forward. The corporation itself is the legal entity, and it has and is held legally liable for its actions. Again, you know, you have your segregation you need to observe and follow all the corporate formalities. Again, under the, you know, check the box rules, you know, you can change the regular corporation to an S corporation, which makes it flow through. And, you know, they're easy to get into, but when you do try to get out of a corporation or dissolve one or pull assets out of one, then you do have some tax issues that come into play at that point. Advantage of the corporation, limited liability, just like we had with the LLC. Documentation is more straightforward, as I mentioned. It's what people are used to. Ability to raise capital more easily through the sale of stock to shareholders. Corporate tax rate is lower than the individual rate. That came into play a couple of years ago when they did a corporate flat tax rate of 21%. No self-employment taxes, which there are with LLCs that are either sole proprietorships or single member LLCs, that is, or partnerships. And it's easier to attract investment sometimes when you have a corporation because you don't have that flow through issue. And you also don't have some of the owner restrictions that S corps have. And again, you know, as I mentioned there on the end, you know, if you go public, you've already got an organized corporation, so you're good to go as far as that goes. Disadvantages: double taxation, because you're taxed at the corporate rate, and then if you get a dividend, then that dividend again is taxed at your personal rate. Incorporation time takes time and money. Incorporation process takes time and money, and the potential minimum taxes at the state level. And again, not as flexible as a partnership or LLC. You know, when you get in, it doesn't allow you to do things pro rata or special allocations to certain people. S corporation, this one also has a lot of, you know, this is more of a tax entity, and it does have very strict rules you have to follow for tax purposes. So either a corporation or an LLC can elect to be an S corp. So you have overlap there. You can make it on the app when you create it, or you can make it down the road. If you make it on the outset, it makes it pretty simple, and it's treated as a pass-through entity from that point forward, and anything it earns, you know, flows through to the owners. Profits and losses flow through the shareholders, whether or not they are distributed. So if you get a distribution of cash, that's not what you're taxed on. You're taxed on what the S corporation actually earns. Advantages: distributions not taxed, and you get basis adjustments for the profit and losses similar to other pass-through entities. So if you leave your profits in the S Corp, that creates basis for down the road to offset gains in the future. Disadvantages, you know, a lot of the disadvantages are due to the IRS rules. You can only have a single class of stock. The one exception there is that you can distinguish between voting and non-voting. That's the only difference you can have in different stocks. The owners have to be U.S. individuals, estates, and certain trusts. So a partnership can't be a member, can't, you know, be a stockholder in S corporation. And if you violate some of the rules, you'll just lose your S corp status and be treated as a C corporation. The last bullet there is just on the conversion process. If you were a C corporation, turn into an S corporation, and there's profits in that C corporation that haven't been distributed, or if there's unrealized gains, you have to track those, and they may be taxed later if something causes them to be realized. Again, here's some of the requirements for the S corporations. You have to be a U.S. citizen to own it, certain trust, and only 100 shareholders, one class of stock, as I mentioned, and distributions of appreciated property may be taxable if formerly a C corporation. Okay, now we're going to get into some of the filing requirements. Tax rules for classifying business entities are largely, but not entirely, independent of state categories. And that's, you know, for the state categories, you have your LLC and you have your corporation. Tax categories, you have your partnership, which could be an LLC. You have your S corporation, which could be an LLC or a corporation, and then you have corporations. So they're comparable, but not the same. So again, as I mentioned, the second bullet, you know, a lot of times I'll ask them how they're taxed. They say they're taxed as an LLC. Well, LLC is not a tax flavor, for lack of a better word. LLC is an entity type. It can be taxed in various ways. So the one thing that is always consistent, a corporation is a corporation. So it's taxed either as a corporation or an S corp if it's elected as such. Again, talk about three classifications: corporation, partnership, or nothing, which is basically a disregarded entity. And that is when we have a single member in an LLC. So back to S corps, just to distinguish them from the partnerships. They're not taxed as partnerships. They have their own filing. They're not subject to a corporate level tax, as a corporation is. They are actually considered corporations for tax purposes. And they resemble in that, but they're flow through, so they resemble partnerships. They fall under some of the subchapter C, which are the corporate tax rules that apply to C corporations, and whereas partnerships fall under subchapter K. That's a different tax section. Here's just some default rules. If you have an LLC and the numbers of members change, you know, disregarded entity to a partnerships, that would happen if you are a single member and you add more members down the road. And then partnership, if one guy buys the other partners out, then you could wind up back to a disregarded entity. And that's, you know, as long as we're using the default of partnership or disregarded entity and haven't made an S selection or a C, check the box. Here's the basic filing requirements that we have for a single member LLC. So the default is disregarded entity, and you report that on the single member's individual income tax return. That's your Form 1040. The activity could show up on a Schedule C if you're self-employed, if it's an operating business and just you, or it could be on Schedule E, which would be like a rental property that somebody's put in an LLC. Kentucky requires you to file the Form 725, which is where they collect their limited liability entity tax, which is the $175 I mentioned earlier. And you will also be filing a Louisville Metro LL3 if the business or property is located in Jefferson County. And then if you do have tangible personal property, which, you know, that would be your furniture, fixtures, equipment, that sort of stuff that you can touch and move, and or inventory, you might have to file a Kentucky personal property tax return. That same single member LLC, if it elects S Corp status, instead of being on the 1040, it would file an 1120S. And that's the subject, that's the S corporation tax return. Kentucky has a new form for these flow throughs, which includes the S Corps, and that's a form PTE. This S Corp would also be filing Louisville Metro if its operations are in or it does business in Louisville. And again, you have that Kentucky personal property tax return if you have tangible property or inventory. If you have a multi-member LLC, the default is you're filing as a partnership. And that would be a Form 1065. Now, what happens there is the 1065 has Schedule K1s attached to it for each of the partners. And that K1 shows your share of the income or loss from that partnership. And you pick that up on your 1040, and then pay the tax on your 1040. Kentucky, again, has that same form that we had for the S Corp, the PTE, which is new this year. Louisville Metro, again, OL3 if you're doing business here in Louisville, in the Jefferson County. And again, the personal property tax return if it's applicable. The same multi-member LLC, if it elected to be an S Corp, it would have to do the S Corp filing papers. The 1120S, as I mentioned, that with the 1065, it has K1s attached to it, which show your share of the earnings that you pick up on your 1040. The PTE, which is the new Kentucky pass-through entity return, that S Corp would have to file Louisville Metro, and again, personal property tax return. Filing requirements, these would be just for a corporation. If that corporation's an S corporation, again, the same forms there, the 1120S, the PTE, the L3, and the tangible return. And then if you just have a corporation that's taxed as a corporation, you have the Form 1120. For Kentucky, you have a 720, and again, the L3 and the personal property tax return. Some more general filing requirements here. A single member LLC that's disregarded, once it's organized in Kentucky, it must file a Kentucky and Louisville return. They'll want a return every year from, if you organize it on December 30th of 2020, they want a 2020 return in Kentucky and Louisville. As far as federal goes, if there's no receipts or expenditures, you really don't have to attach those additional schedules, the C or the E, to your 1040. Multi-member LLC, once it's organized again, you must file that Kentucky and that Louisville return and pay the $175 to Kentucky. Federal, if a partnership has no receipts or expenditures, so no cash in, no cash out, or no property in, they do not require that partnership return for federal purposes. And that is in the partnership instructions. The Form 1065 instructions does mention that if you have no receipts or expenditures. The S Corp, once it's organized or the S election's made, you must file all the forms, the federal 1120S, the Kentucky PTE, and the OL3. And the corporation, same thing. Once it's organized, you must file the 1120, the 720, and the OL3. Personal property tax return, which could apply to any of these entities, it is required if the fair cash value is greater than $1,000 here in Kentucky. And that would cover inventory or your equipment. That equipment, they apply factors to it. So if you bought a computer 5 years ago for $1,000, it might only be worth $200 when you get to calculating the fair cash value. So, you have to go through the calculations anyway to determine if you have to file. But there is a de minimis threshold of $1,000 there. Other taxes you could be liable for would be sales and use tax. That's payable to Kentucky. And the filing frequency depends on your volume. So, they have, some people are annual, some are quarterly, some are monthly, but it depends on your volume of transactions you do and the dollar volume. Sales and use tax, generally it was only applying to tangible items, the sale of goods. A couple of years ago, they did expand it where it does apply to certain services, veterinary services, also dry cleaning services. There's a list that Kentucky has that it applies to. They did not apply it to professional services, but they do, the grooming for your pets is now taxable. So there's a special list of services that they did apply the sales tax to. Employment taxes, you really want to make sure you know what you're doing when you get a payroll. And I would really recommend using a payroll service, just because of the liability that could be associated there if you ever get behind, and just how stuff starts snowballing. The federal wants the federal withholding and the FICA and Medicare. Kentucky has a Kentucky income tax withholding and Kentucky unemployment. Louisville has a Louisville withholding, and I didn't mention federal also has a federal employment. So as I mentioned, I would really highly recommend using a service for the employment taxes. Talk a little about employees of the, and this is really talking about owner employees of the different entities and how they're taxed. Determining whether an owner who provides services to a business entity as an employee can be difficult. Most often likely for owners who provide services to a corporation to be treated as an employee than it is for owners of pass-throughs. S corporations, the owners of S corporations could also be employees if they're providing services to the S corp. When you get into partnerships, the owners are not considered employees. They get guaranteed payments rather than wages and W-2. So when you get into this, the C corporation may have an advantage there because the employee provided health insurance is deductible to the company and it's not taxable to the employee. You can have group term life and other tax deductible fringe benefits that the owner can participate in. And the owners of the pass-through entities generally receive health benefits, cannot receive health care benefits and other fringes tax-free. Usually that winds up being, taxed on their individual level, just the amount of, compensation that equals what they got in health benefits. They might get an adjustment for it on their individual return on certain items, but others might just be additional compensation to them. The pass-through owners, for the partnership, they're generally subject to the self-employment tax, whereas the corporate employee that's getting a wage, they're only liable for the Social Security and Medicare taxes. Self-employment tax is basically, the owner has to pay both sides of the FICA and Medicare. So it winds up being 15.3% as opposed to, 7.65%, which is withheld if you're an employee. Some employment tax issues, corporations. So officers are paid salary, which is subject to the employment taxes. Dividends and retained earnings are subject to income tax at the shareholder level. As corporations, officers paid a salary, same thing. Dividends are not subject to income tax at the shareholder level, provided they have basis. And then partnership LLC, partners are not employees, so they aren't subject to the employment taxes. They're considered distributions of earnings unless they're guaranteed payments. So their compensation winds up being subject to self-employment taxes on their share of the income. No tax again is on distribution, similar to the S corp. Some fringe benefits, corporations fringe benefits are available to all shareholders who are employees. Cannot be discriminatory in favor of highly compensated employees. S corporations, owners owning 2% or more are required to include those fringe benefits in their income. Basically, it gets added to their wages on their W-2. Their share of their, whatever the company's paying on their behalf for health insurance gets added to their W-2 and so forth. Again, partners also have to include those fringe benefits in their gross income. Basically, it's a guaranteed payment, which is subject to all taxes at the individual level. As you know, self-employed individuals are required to pay a self-employment tax equivalent to a FICA tax rate. While certain amounts are non-taxable, such as rental and dividend income, most earnings are taxable by 12.4 Social Security tax and 2.9 from Medicare. That's where you get the 15.3%. S corporations have a distinct advantage when it comes to self-employment taxes. Neither the corporation nor the shareholder has to pay self-employment taxes on distributions to the owner. If you remember, that's because those owners are probably getting a W-2, wages, paid. And then on that, they withhold payroll taxes as required, and the remainder of distribution is, if there is another distribution above and beyond what they get in payroll, that's not subject to self-employment or payroll taxes, which can save a lot on, basically the FICA and Medicare. Single member LLCs, the individual is treated as sole proprietor. And so for self-employment purposes, the entire amount of the profits is included and subject to the self-employment tax. So the 15.3% the owner winds up paying on that. I had a couple of comparisons of how the taxes affect in a couple scenarios, just so you'll see how the double tax and so forth happens. On a C corporation, the double tax example here. So you have a business, revenues of 200, expenses of 100, net income of $100. The corporate tax is going to be 21%. Again, that's a flat rate, so $21. That leaves $79 that can be distributed out to shareholder. Might not be, but we're just saying it is in this scenario, it will be distributed out to the shareholder as a dividend. So then that tax is subject to a tax. That dividend of $79 is subject to a tax of 23.8%. That is basically the highest rate, 20% on the dividend, on a qualified dividend, plus the 3.8% Obamacare tax, for lack of a better term, which gets you at the $18.8 that the shareholder has to pay at their level. That leaves basically, take home or money they're putting in the bank of $60.20 after both levels of tax are paid. So we did not include state or local tax impact, which would be, 5% at both levels for Kentucky, and then 2.2% at the corporate level for Louisville, if it is a Louisville entity or doing business in Louisville. So that one puts $60.20 in the owner's pocket. Pass-through example. So we have revenues of $200 and expenses of 100 again. Net income of $100, no entity level tax. $100 passes through to the owner. And this is assuming they pay tax at the highest rate, 37%, which is $37. And that gives the owner $63. So you'll see in this scenario, $100 income going to the owner. We're going from $60.2 up to $63 going to the owner on this. And this would basically be representative of an S Corp setup here. Again, it disregards the state and local. State would be $5 at the individual level. Local would be 2.2% up at the corporate level. Okay. Also, especially with startups here, if we were starting off the whole life of the entity with losses, Pass-through entities will allow losses to pass through to the owners if the owner has basis in it. So if you've invested $5,000 in your startup and the first year you have losses of $2,500, you would get to take the benefit of those losses on your personal return. That goes for the partnerships and the LLCs, Texas partnerships, and as disregarded entities. The LLCs and partnerships, they also allow the entity debt to be counted as basis, including the partner share of non-recourse debt. Get over this. So if you've gone out and borrowed money from the bank, or your LLC has borrowed money from the bank, that would go into your basis in the entity. So you could take losses against that also, that amount. S corporations, they do not allow the debt to be counted towards basis. There's also other rules like passive loss rules that might come into play and limit your loss allowance. But if you're active in the business, those shouldn't come into play. Outside investors. So C Corps can issue convertible preferred stock, and that's typical for venture capital investment. A lot of times people have debt that might be convertible over to stock, and that again would be, if you have a C Corp, that would come into play. Investors who do not want to be taxed on the entity's income, which would be nonprofits or foreign investors, they may refuse to invest in a pass-through. And we've been seeing more and more of that, where even domestic investors do not want to invest in a pass-through. And a lot of it's just because of the tax complexities that come out of it. They don't want to wait for a K-1. If the entity extends their return, then all the owners have to extend their returns. They might not want to wait for that K-1, or sometimes if the entity is involved in several states, you might have to file returns in 5 states. The owner, the investor, won't want to start filing in those 5 states. So that would be another reason that they might want to, limit their investments to a C corporation rather than an S or a partnership. They can also set up, that's usually for foreign investors and nonprofits, where they'll set up a blocker corporation so they won't have to file in the states and won't have to flow through the income and pay tax on it. Tax distributions, and this usually is dictated by the operating agreements. So a lot of times the operating agreements might require the LLC to make a tax distribution every quarter so that the owners have enough money to pay the taxes on their share of income. Sometimes there's a timing issue there. You might have to be more specific about when you want those distributions paid out. But for the most part, that's a function of the operating agreement. C Corps usually don't have that problem. They're only going to be paying tax when they get a dividend from it. So they'll have the cash from the dividend to turn around and pay the tax at their level. Here's considerations, consider complexity of tax returns, and then the investors and owners' appetite for complicated tax structures. Again, that gets back to whether you want a C Corp or some sort of flow through. Pass-through entities generally have more complicated structures with consequences to the owners. As I mentioned before, the investors get those K-1s that indicates what they have to report on their returns. And sometimes that's not just limited to your income. There could be all kinds of other things that might be flowing through to you, credits and stuff that would be included on the K-1s. Reading and understanding provisions regarding tax allocations might be confusing, and that gets into LLC operating agreements and partnership agreements, where you might have special allocations of income, where certain people get the first monies and so forth. Changes to debt of pass-through entities may have consequences to the owners. And yeah, that comes into play because, especially if you've taken losses against the debts, as we mentioned with the basis earlier, Now, if those debts get paid off, it could wind up hitting you with an unexpected gain later in life. And then the additional state filings, as I mentioned, because you might wind up with K-1s from activities in several different states. Other advantages to LLCs are the special allocations, the gain and loss. We've mentioned that before, which is different from the pro rata ownership that a corporation requires. And through a partnership LLC, appreciated property can be distributed to owners without double taxation. Excuse me. Corporation benefit, you have that lower corporate rate that came into play a couple years ago. That's 21%, a flat tax really. It's become less costly, especially for businesses that do not plan to make distributions to shareholders. But then on the flow-through side, in order to kind of put them on equal playing field with the corporations, a couple of years ago, we got this 20% pass-through deduction, or QBI, or Section 199A. It has several names. So really, the income from the flow-through going to the owner, basically 20% of that income you wind up not having to pay tax on. There's certain exceptions to that rule. Service businesses, and these are really, they're not exceptions from main, they really kind of phase out after you hit certain income levels. So service businesses might not be eligible for the 20% pass-through. W-2s and capital expenditures can limit the amount of the pass-through deduction. You might not get the whole 20%. And then compensatory payments, such as guaranteed payments, the 20% does not apply to those. Here's an example using the same facts that we had in the other examples earlier. So you have a business with net income $100. Basically, you take 20% off the top, leaves you $80 in tax that's subject to tax. And then your tax at 37, or using the highest rate for federal tax, is a tax of $29.60. Take that off the off the $100, and you get your cash in your pocket of $70.40. So that helps you out quite a bit and puts quite a bit more in your pocket compared to the old law or the corporate tax, the 21% double taxation. Almost $10 or over $10 more using a flow-through and the flow-through and being eligible for the flow-through deduction. Other provisions: corporations can deduct unlimited SALT and property taxes, which may affect decisions in some entities. And then also bonus depreciation may mean that more businesses are in a loss position. A few years ago, the bonus depreciations where if you buy a piece of equipment, you can write off the whole thing in the year you acquired it. So, if you've financed that equipment and then, write it all off, that could easily put you in a loss position depending on your other activity. Other deductions for corporations, basically, expenses that are ordinary and necessary, for the conduct of the business. You can have business vehicles, lease or purchase, track mileage or actual expenses. Usually it's whatever comes out better on that. Some of the retirement plans to start off with, really the simple plan, it's basically that, it's kind of simple. So usually people will start off with that one in a startup, or after they have a couple years under their belt, and then you can defer up to 13.5, and then you have the employer match of 3%. And then the next one usually is the self-employed pension. That's limited 20 or 25% of the net income with a max of $56,000 for the owner. Those are the one people start out with. The simple really is, low administrative cost, And once you get into self-employed pension, a little more administrative costs, and then 401ks down the road, because that does include quite a bit more expenses. State and local taxes, LLCs and S corps, we mentioned this earlier, they're subject to the Kentucky minimum limited liability tax of $175. There's also another, gross receipts tax that Kentucky has that'll kick in once you hit 3 million in revenues, and then it phases in up to 6, and then after you're at 6 million, I believe it's fully phased in, which can, add up. The Kentucky income tax rate's 5%. Louisville income tax rate's 2.2% on what's earned in the Louisville Metro, which is Jefferson County. And that's the end of my prepared notes. If we have any questions, I'd be happy to address them. And if not, if Delene has any parting comments, or we can turn it over to Mike.
Awesome, Steve. Thank you.
Yeah, I would just say that we have open office hours. We do offer free open office hours. So if you are interested in scheduling a time to chat with Steve, or if it's about something else that's not tax related, we have 60 other CPAs in our office. So you can email me. I'll put my email in the chat, or you can email Steve directly.
What days and times do you do your office hours?
Sorry?
By appointment, the open office hours. You would just contact Delene and she would get it arranged, I believe. Or there might be a link in there, Delene, where you can arrange those.
Yeah, it's better if you just copy me, because our email spam filters are pretty crazy and sometimes they get blocked or held.
If we have a comment here, do we mainly target Kentucky or other states too? We have the capability of working with anybody from any state. I do have companies that are they have activity in almost all states. And then, I have clients that, might just be from a random state. We are also a member of the BDO Alliance, which is a group of CPA firms across the United States. So if one of our clients, is from Missouri or something and has something very peculiar to that state, we can reach out to a brother sister firm in Missouri and get your answer on that too. And so we are basically able to handle anybody in any state.
Steve, I love the examples, especially when you were doing plugging the numbers in. For the sake of startups, especially here in Kentucky, a lot of them will start as an LLC, for example.
Right.
First of all, can you change? And if so, when or what milestones are really required of you to change, or you should change?
If there's no outside reason to change, other investors wanting you to change or something like that, if we're still talking about just the founder or founders, I would stay with just the default LLC classification of a partnership or a disregarded entity until the income reaches such a level that we can benefit from the tax-free distributions from an S corp, and then make an S election. We still have an LLC, but it's taxed as an S election. And you have to get to a point where it benefits you enough to offset the additional expenses, because when you get into an S corporation, then you have to start paying wages to the owners. So you get into some payroll expenses, administrative expenses, in taking care of your payroll and that sort of thing. And then especially if you're disregarded and go to an S corp, then you've also started, an additional tax filing for income tax, because you have the S tax forms. So, I would say, I think it usually winds up taking, income of 100,000 or 150,000 in order to make that economical for you.
And that's income, not profit, correct?
No, I mean profit. I'm sorry, net income, bottom line income. Mm-hmm.
I actually have a follow-up question on that. So from your presentation, and correct me if I'm wrong, it sounds like if you're, in the process or looking to secure venture capital funding, then you probably want to be a C corporation. Is that right?
They might start wanting to steer you that way. Yeah. But
Okay.
I would want to stay as a LLC, taxed as a partnership, or disregarded as long as you can.
Okay. Yeah, that was my actual question based on the story you just told. Yeah. So yeah.
Yeah, I would want to stay district, the true LLC with the default, the default tax classification as long as you can, until you get that investor lined up, ready to put his money in and then do the conversion.
Steve, can you explain why an investor would want you to switch?
Ease on their side is where it would boil down to, or if there's some other reason because they're a foreign entity or something and don't want to be paying U.S. tax on an entity, or don't want to wait. I've seen more and more it's because they don't want to wait for those K-1s to come out. Just because it delays their tax return, or it might open up them to more tax jurisdictions. If you invest $100,000 in a company that operates in 15 states, and you are always just happy filing your 1040 in the state you reside in, and all of a sudden you get a K1 that has 15 state K1s attached to it, and you're having to, it can really complicate your individual return. In the same way with a corporate return, it could open them up to different states too that they might not want to be having to file returns in.
Nishant asks, can LLCs raise capital from crowdfunding?
Yes, I don't see why not, because that would still be individuals. The money would still be coming from individuals. So that shouldn't be a problem for an LLC or an S Corp.
Steve, can you tell us about Delaware, incorporating in Delaware, and why that can be important?
Well, that's just has a long history of being friendly to corporations, low taxes to corporations, and a lot of times you're just able to avoid taxes to other states if you incorporate in Delaware and your business gets sourced there. If you incorporate in Delaware but you still actually have operations going into other states, those other states now are going to pick you up anyway. But if it's more of a intangible type operation or investments or something like that, then Delaware is more favorable, I believe.
What other questions do we have for Steve?
Hey, Steve, this is Nishant again. Great presentation. Thank you. Very confusing taxes are for startups. So very, very confusing, even the terms FC, et cetera. So really appreciate you and Delane and all taking the time. Why is it then why are startups registered in Delaware? Because I would imagine there are almost many of them platforms, et cetera, are in many different states. Why do they still always elect to incorporate in Delaware?
I don't know. I mean, a lot of the startups will incorporate in their home state, and then they might, organize in their home state wherever they are. But then, when the investors come into play or something, they might move them to Delaware or reincorporate them or merge, into Delaware and do a merger or something. But, I'm not sure just what all their favorable tax issues are up there, but, there's a couple other states that are like that too, that have, come in and out of favor as far as incorporating or not. And, Nevada's a big one too, that comes into play a lot. And it's just, a lot of it's just the state taxes aren't there. So whatever they can actually, allocate to the home state, being Nevada or Delaware, they might not have to pay state tax on that income.
Gotcha. Thank you.
Mm-hmm.
Well, awesome. Well, thank you so much, Steve. Appreciate you joining us, as well as you, Delene. We love Delene and her activity in the ecosystem. This has been a great conversation. I'm going to go ahead and hit stop on the